All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So be sure to go down to the description box right now and hit the thumbs up button and subscribe to this channel so that you're notified whenever I come out with any new videos. Today, I'm finally getting around to editing some older content that I shot. This one here is over 2 years ago. And the subject is, don't make this policy design mistake. As I stated, this video was shot over 2 years ago. It was one of my first videos. It's not as polished as my newer stuff, so I apologize for that. But I hope you enjoy the content.
So today we're going to be talking about the number one mistake that I see people making when they set up their policies. And this mistake can cost them thousands of dollars. And I'm not being hyperbolic when I say that. Even in the relatively small policy illustration that I'm going to show you, you're going to see that this client would have lost thousands of dollars in cash value as well as lost accumulation potential over time. This doesn't just impact real estate investors doing the double play. This impacts anybody who's doing a life insurance retirement plan as well. Whether you're leveraging cash value to invest in real estate, or whether you're leveraging cash value to generate tax-free income for a life insurance retirement plan, you need to have a maximum overfunded life insurance policy. Both agents and policy owners make the same mistake when they're designing policies. I'm Tom Rutkowski with Innovative Retirement Strategies, and I confess I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. So the goal of this channel is to demystify life insurance and give you the tools that you need without ever talking to an agent to get the most optimized policy design possible to maximize your wealth accumulation through your use of the double play. And the double play, of course, is putting your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So what's the big mistake? Putting a lump sum of premium into a policy at the very beginning. It's counterintuitive. It seems like that would be a good idea. But doing this can cost you thousands of dollars. And I'm not joking around when I say that. I can show you policy examples that I've reviewed where the people have lost or will lose well over $100,000 in a very large policy. So it's very easy to make this mistake, and I see agents and policy owners both doing it. And in fact, agents should know better, but a lot of times they don't. If they don't understand the inner workings and what's going on under the hood of a policy, they're not going to know why this mistake is so costly to their clients.
All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary.
All right, so let's get started. Why is it that a lump sum in the first year is such a bad idea? So I did an entire video on the costs in a life insurance policy. So I highly recommend going back and watching that video or going to my website and reading the article that I did on that as well. In fact, I even covered this topic in the video that I did on policy costs. So you can go back there and you get a briefer version of what we're talking about here. But in this video, I want to dive a little bit deeper into this topic and talk more about the specific example. So the bottom line is, in any life insurance policy, the first year premium is what determines the death benefit in the policy. And the death benefit of the policy is what determines the cost. The higher the death benefit, the higher the costs and commissions to the agent in that life insurance policy. And one of the charges that's tied to the death benefit is the policy issue charge. This is a charge that's typically spread out over the surrender charge period of the life insurance policy. So if you've got a policy with a 10-year surrender charge, that cost is typically assessed over 10 years. If it's 15 years, it's assessed over 15 years, and so on. It's not unusual to find some policies that have a 20-year surrender charge period, though most of the policies that I use are 10-year surrender charge periods. So when you put a lump sum premium into a policy and then work backwards to solve for the death benefit, you end up with a higher death benefit, even though the subsequent premiums are going to be much lower. And now that you've set that death benefit, you've got 10 years worth of charges coming that are going to be tied to or as a result of that large upfront premium. So when you go back and lower the premium in years 2 through 10, you've got the cost of a much higher death benefit being subtracted from the premium, which results in much less cash value going to the policy. So we're going to talk about some pretty advanced life insurance concepts, and I'm going to assume that you have the basics of policy design. If you don't, I did a paper on policy design that's available on my website. I'll put a link in the description. And I also did a video on policy design. And that video will go into the difference between minimum and maximum overfunded life insurance policies, as well as explaining what the cash value of a policy really and truly represents. So if I've lost you with some of the language we've talked about so far, go back and watch those videos, and I'm sure they'll help build a foundation so that you can dive in a little bit deeper and keep up with this discussion. So I'm putting up a graph of a maximum overfunded life insurance policy design. And we're looking at the death benefit of the policy in orange and the cash value of the policy in blue. And this is a policy on a 45-year-old that's putting in $100,000 a year for 10 years. And in a maximum overfunded life insurance policy, again, the death benefit is a function of the first year's premium. And in this case, all of the premiums are level for each of those 10 years, $100,000 a year for 10 years. So when we work backwards from that initial premium, we come up with a death benefit that looks to be, in this case, about $2.5 million. And then each year, as the client continues to put in another $100,000 premium or pay another $100,000 premium, the resulting cash value is pushing up that initial increment of death benefit by the amount of the new cash value in the policy. So you see the death benefit maintain a fairly steady corridor, actually not fairly steady, it is a steady corridor from year 0 at the beginning all the way through year 10 when the death benefit is reduced to drive the cost out of the policy. And all through those 10 years, the policy issue charge is being assessed on the cash value of that policy. But in this case here, the premiums are level, so that cost is kept to an absolute minimum and is taking the minimum amount of each premium that's going into the policy. So now we're looking at an extract from an actual illustration, and this one's a little different. This is $12,000 a year for this client all the way out through age 65. And I'm cutting it off some of the years here, and we're just going to focus on the initial years. But even though it's not a 10-pay example like the previous example, the initial premium is what drives the death benefit, and the death benefit is what drives the cost in the policy. So on this illustration, we're focused solely on the premium and the resulting cash value and the cost of the policy. The death benefit isn't even shown. So let's take the opportunity to go through all the costs in a universal life insurance policy, as long as we've got this illustration up. So in the first column, you see the premium charge. And the premium charge is a function of the premium that's paid. So in this case here, you can see that it's about 5.5% if you were to break out a calculator. So every time you put $1 of premium to the policy, 5.5% of that is going to the cost. If you move over one column, we've got the cost of insurance charge. And that's literally the cost of a 1-year term policy to cover the death benefit protection. That's that increment of death benefit that has to be purchased at the beginning. And you can see that every year, as you would expect, as you get older, the cost of insurance goes up. In the next row over, we've got the policy issue charge. And the policy issue charge is tied to the death benefit of the policy. So the greater the death benefit, the greater the policy issue charge. And in this case here, where we're solving for the minimum non-MEC death benefit, we've got a cost of $854 per year in the policy. And you can see that that charge is assessed every year for 10 years. In the final column labeled additional charges, we have a flat annual fee of $60. And that charge is $60 whether the death benefit is $100,000 or $1 million. It's just a flat annual charge, unrelated to either the premium or the death benefit. So take note of the policy issue charge at $854. And again, remember that is a function of the death benefit, and that charge is being assessed every year for 10 years based on that initial premium of $12,000. So now we're looking at the same illustration essentially, only now we're assuming that this client had $24,000 sitting in the bank that they wanted to put into the policy in addition to funding it at a level of $12,000 a year. So the first year's premium, instead of being $12,000, is $36,000. And then every year after that, it's $12,000 a year, all the way out through age 65. Now remember, I said that the death benefit is a function of the first year's premium. And it doesn't matter that it's just a one-time premium and that it's a lump sum. If you look at it, the policy issue charge is now $2,292. Not quite 3 times as high as it was before, but still a fairly significant difference. And worse, in the subsequent years when the premium drops back down to $12,000 a year, you've still got that very large annual charge being assessed. So if you remember my previous videos, I've always said, in a well-designed maximum overfunded life insurance policy, the total costs should be about 15% of the premium. If it's any greater than that, the policy was not designed properly. So here you see that if the premium charge is a function of the premium, and the cost of insurance is simply a function of the death benefit, the policy issue charge is also a function of the death benefit. So it is the greatest chunk of those policy expenses. And when you see a policy design that's not 85% cash value to premium, this is the culprit right here. The death benefit of that policy is too high, and the policy issue charge is too high as well. And the larger policy issue charge is consuming a greater proportion of the premium dollars. So what did we learn here? The lump sum policy started with $24,000 more, but had only $13,310 more dollars after 10 years. And I'll go back to it here in a second, but if you look down at the bottom, there was only $9,593 more after 15 years. The extra $24,000 premium led to $14,380 of extra policy issue charges, and that's the $854 times 10 is $8,540, and the $2,292 times 10 is $22,920. So the client would have been much better off by spreading out the $24,000 a year out over 5 years. So this client could have put roughly $5,000 a year into a 5-pay design and done that policy on one of his children or his spouse and taken care of some of his other life insurance needs. Or he could have put it into this policy and then done a face reduction at the end of the 5th year to reduce that life insurance corridor. So here we're looking at a graph of 2 different scenarios. So I know that it's difficult to look at a table full of numbers and make sense of what I'm talking about here. So here I'm putting up a chart that is graphing what the numbers in each of those illustrations look like out over time. And in this case here, I'm actually giving the benefit of the doubt to the design, and I've gone back and reduced the face value of the lump sum policy after the 10th year to try and drive out some of those costs. But most of the time, agents don't do that. It's very difficult to go back into an illustration and manually do that face reduction after the 10th year of the policy. Most software just simply leaves that large increment of death benefit going out all the way out through age 65 in this case, where then we would do a face reduction to drive out the cost of the policy in order to maximize the tax-free retirement income potential of this policy. Because at age 65, the goal is preserving the cash value and maybe not so much on the death benefit protection side. You can see that the policy that's designed on the level $12,000 a year is growing at a faster rate. And had I not done the face reduction on the policy with the large lump sum premium payment up front, you can tell that there would have been a crossover where the $12,000 a year policy would have started looking even better than the the policy that started with the lump sum. But in this case here, I actually did that face reduction on the policy with the lump sum after the 10th year. And what that did was lower the death benefit to the minimum non-MEC after the 10th year. So at that point, you can see that all of a sudden the two lines begin to stay relatively perpendicular to each other as time goes by towards age 65. So the reason I'm showing you this is just that you know, even if you did design your policy wrong, it can be saved.
All right, so just wrapping up, the primary point of this video was simply to show you that you don't want to put a lump sum premium into a life insurance policy. The first year premium is what drives the death benefit. So all of the calculations run off of that. And when you do that, you're going to have a higher policy issue charge that's going to run for 10 years, and it's going to basically suck up all of that extra cash that you put into it over time. You know, if you're not a life insurance agent, it's very easy to make this mistake. You know, it makes intuitive sense to want to put money into a policy. If you have it sitting in a bank account, it makes more sense to have it into your policy, right? But if you don't understand the rules and how life insurance works, you know, you can make a very expensive mistake. So with that, I've got no more on this topic. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I recommend going out to the Double Play channel on Facebook and join that community. It's a group of like-minded investors who are utilizing life insurance to invest in real estate or are there to just simply learn. But I've got a lot of resources posted there. I've also got my website, innovative-retirement-strategies.com, and there's usually written blogs that correspond to all of the YouTube videos and other content that I've got. And finally, if you find this content valuable, please consider supporting this channel. Any support allows me to, or actually gives me motivation to continue making these videos. So with that, I will see you in the next video. Thanks.